Hello, everyone. Hello, sir. Welcome to Decoding Markets in Three Moves with none other than Mr. Rohit Srivastava. Welcome back, sir, once again. India's renowned market strategist and the mind behind Indiacharts and Strike.money. In each episode, he unpacks the market's most pressing questions, simplifies complex trends, and reveals actionable strategies in just three clear steps. So, whether you are a seasoned trader, a curious beginner, so tune in and let's discover the markets together. So, it's a Friday, sir, end of the week. How's the market?
Yeah, it's nice to see the end of the week. And end of the week, we have managed to close above the 20-week moving average. So that's one step forward. However, the last two times that happened, we failed to stay above it and then again went back below it. And so again, we are going above it. The good news is that each time that has happened, the last two times, each time we made a higher bottom, higher, higher, higher. So we've been zigzagging, but I think eventually, if you're making higher bottoms and you're making higher highs as well, we call that a Dow theory uptrend. So in terms of Dow theory, we are already in an uptrend. The only thing is, are we ready to take off? And I would like to think we are, because I doubt there is any more negative news to come in from the US. They've sort of announced every possible tariff they can to hurt India. And now they're talking about, if you heard the interviews today, Scott Bessent saying, yeah, we are just discussing with India. Over the next month, they're going to buy less oil from Russia and more from US. So I think that's pretty much indirectly saying it's achieved. The market is still not smelling it out. Otherwise, it would be up 1,000 points. So we'll slowly smell it out, and we'll get there by the day of the announcement. That we have a deal, and the deal will be on in the front pages of every newspaper. And that's how markets are. They're always anticipatory in nature. So if you can't anticipate these things, then you'll keep expecting something bad, something bad, something bad. Earnings are not good, becho, 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 and you'll miss out on the entire move. And that's what is happening on the street. A lot of people, I can't say everybody, but a lot of people are quite negative. They don't want to accept that things can get better because things are already worst. When things are worst, they can only get better. You can't go from
Right, because
worst to worst. There's no worst to worst.
right, because that is the baseline, and there is only up, there is no down on that. So yes.
Yeah.
So, so speaking of the currencies, how might the outcome of the recent Japanese elections and the current resistance level near 154.60 influence the USD and Japanese yen currency pair? And what are the possible implications if the currency pair rolls versus continuing its rally?
Hmm. Yeah. That's a question that requires a deep dive. And so one of the things I would do, and I published this chart in the morning. So I'm going to just open the USD JPY weekly, and it looks something like this. So what is happening with the Japanese thing is, you got a dove at the helm in Japan, and a dove meaning somebody who's interested in weakening the currency to strengthen the economy, and which is what you had earlier also in 20 way back here 2012. You had Abe, who was of the same opinion, and then currency fell, and then it consolidated for a long time. And once again, you had another round of that, and now again it's consolidating. The question is, will we break out of this range to the upside or not? Okay, so that is where the 154 level comes. So while she might be a dove, the problem is right now we have a lot of doves. The dollar has a US dove, India has an Indian dove, and so which currency is going to rule over the other is the really bigger thing. So in the short term, the USD JPY may have gone up, but when the US starts cutting rates, then the DXY or the USD starts going down. And so there's a chance, and I don't know, either the yen and US dollar will diverge, which means the yen goes up and the dollar goes down, or else the dollar index will fall hard enough to bring the GPY down from this level, and we'll be going down together. So then you have a triangular, descending triangular structure, and this time you might even break the lower end. Who knows? So if you don't cross this, then it falls along with the dollar and the rest of the trade, and that's where we are in a very, very interesting inflection point as far as this is concerned. And the impact it has had is it's pulled up the dollar also. So the dollar, which was in this downward trend, is now attempting to break above this line. Now this line break may be temporary. We can say that it's a false break, as long as we are below this high. This high is what, around 99.80. Now, why is all this important? Why is all this dollar currency discussion important? Sometimes it's important for different reasons. This time it has been important for only one asset class, which is gold and silver. If the dollar keeps falling and interest rates are going down, then gold and silver keep going up. And so far, it's relentless. Even today, silver is up 2%, taking back some of the intraday losses from yesterday. And gold actually sold off and closed down yesterday. So it's actually going higher from there. So a very interesting situation to have. So markets are trying to guess what's happening on the currency. The rise of the dollar is what may have caused yesterday's reaction. But I think nobody believes yet that the dollar will go up a lot, and therefore precious metals have rebounded. So that's what it's all about. Can you get the dollar to start going up, or will it remain in a downtrend? And if it remains in a downtrend, the yen just being one of the second most important players in the DXY, because the DXY is a group of currencies, and the euro has the biggest weightage, almost 50%, more than 50%. And I think the yen is the second one. I'm not sure it's 10 or 12 or 15%. And those are the two major movers. So if anybody can impact where the DXY goes, it's these two. So that's I think the whole story behind currencies.
Pretty elaborative, but yeah, got the point of.
Just give me a second. I'll have to be back.
Sure, sir. So I just wanted to announce one thing to all the viewers who are here watching our live stream, that anyone who has joined from their Twitter accounts can also ask their questions from Twitter also. Okay. You guys can actually ask the questions from Twitter. Yes, sir.
Yeah.
Okay. So let's get going to the next question. That is the second question of today's episode. So what are the main factors causing the Indian rupee to hover near all-time lows against the US dollar in the month of 2025, October? And how might RBI interventions impact this movement?
No, so RBI, starting with the new RBI governor, they are intervening much less than before, which is a good thing, because I don't like over intervention. Intervention should be done in a very spaced manner, only when there is a crisis. Every currency movement is not a crisis. Sometimes it's just the adjustment that the market has to do. I mean, if you are consuming more and you're importing more, and there is a currency shortage, your currency is going to weaken, and that's a natural process that should be allowed to happen. Having said that, the new low in the Indian rupee that we saw recently is mainly because of US tariff action. And we can put some blame on FII selling, but FII selling has been there most of last year, and the previous governor was actively intervening and selling dollars and trying to keep the currency from weakening too much. But this year's movement, initially the rupee actually became much stronger as the market started to recover, and then it started to weaken all over again. Now, so the reason for that is been the tariff regime. And what the impact of that has been, the pushing our current account deficit up by almost 0.5 to 0.8%, or maybe even 0.1. I mean, I don't know, almost 0.5 to 1%, in that range. And that has a significant impact, considering that we need to use our existing dollars to make those purchases, for oil. And now that there's so much gold demand, so I'm sure there'll be gold imports. So all of that takes a toll on the currency. But I'm not sure intervening is the right way. I think you need to change foreign policy. So somewhere I hope that they manage some deal with the US. That is one step. And in so doing that deal, we do bring stability to the currency. It doesn't mean we stop buying oil, but tariffs hurt because your overall exports come down. And then if that happens, then your inflows will slow. So once we get over that, hopefully sooner than later, then that part of the problem is gone. Then the only problem will be, you still have an import bill. NFIs are not net sellers. So either you need FII flows or you need FDI flows. You need some form of currency inflow to create the balance. I think the easy solution is a very old one, which was already there. It was no capital gains tax on portfolio flows. See, unless you can seriously attract new FDI in large amounts into India. So if the Prime Minister's office believes they can do that, then yes, then you continue with your tax on foreign investors. But in this environment, putting a tax on foreign investors doesn't make sense, because they're not going to give you their money anyway. If you're going to tax them and you have a weak currency, they are the ones who are bringing stability to your currency. Basically, most of your CAD is getting funded by these portfolio flows. So after years and years of doing that, you notice that FII flows have slowed down ever since we put the capital gains tax. It's a very simple equation. Since 2015 that the tax came into place, most of the time FIIs end up being net sellers. There are very few years where they were buyers because of some good months, but the higher we go, the more and more difficult it has been. Very short periods you actually get a move. I mean, I was looking at the FII graph. See, just look at this, and this, of course, this is NSE data. Some people say, "Oh, this data is not correct. Go to CDSL," which is all fine, but this at least gives you an idea. I hope you can see my screen.
Yes, sir. It's visible.
So now this is the strike platform and the FI data, which you can see at the bottom in the form of a histogram. Okay, so when people last 3 days, you actually had some FII buying, and the TV channels start going gung-ho, 3 days consecutive. Yeah, because we didn't get much buying over here. But you have many consecutive days here. So when you get these rallies, okay, market goes up, you get some buying. But very quickly it goes into a lot of selling. Okay, and this pattern has been all the way. So even when the market went up here, you had some buying days and then selling, buying days and then a lot more selling. And so when you add it all up, when we look at monthly or annual data, what do you end up seeing? You see more down months than up months, right? So even though there may be few months where there's positive flow, very quickly, moment the market stops rising, it sells. So actually net inflow is nothing. On a yearly basis, you look at this since 2021, COVID, the annual is net sell. Why? They only bought for some time around COVID when market was really down. They've been selling since 2015. And that's around where I think the capital gains tax was introduced. So I'm very clear on that theory, that's the only reason they are selling, and they will not be net buyers. You will not get new money from foreign investors if you are going to tax them. That is the single biggest reason for money not coming into India. I think I've said this many times before, but what the heck.
Okay. So moving to the last question. What recent technical signals indicate a potential shift in outperformance between DAX and S&P 500 indices?
Yeah. So I've been writing about this a lot today, and I think in Weekend with Indiacharts last weekend, I actually discussed it in quite some detail. So see, I'm just looking back at data. The exemption on LTCG for listed companies was revoked as 2018. Okay.
Sorry to interrupt, sir. Are you
Yeah.
sharing the screen?
No. I'm not
It's
sharing.
not visible.
I'm not
Okay,
sharing it.
okay.
Just reading it out, just for context on the last point. So 2018 is where says revoked. But yeah, since 2015 and the new regime, we've been seeing selling, and I think that I'll still make that the mute point. Of course, after 2015, our markets were high, so initial selling may have been for other reasons. Now, coming back to the outperformance, so somewhere starting last year, you see, whenever the dollar enters a bear market, usually we expect that emerging markets or other developed markets outperform the US. However, we were still not seeing signs of that, despite the big dip in the dollar in 2023 or even in 2021. Each time the US has done better because most of the stimulus has come from US. US was stimulating the most after COVID, and therefore it made up most of the gains. And then of course there's technology, right? The technological changes happened there. First it was the Mac 5s, now it is the AI trend, and so that has sort of kept the US as the best performing market. And we've not seen that outperformance of other markets, but many of the other markets are actually cheap when you think of valuations. So we started seeing an initial sign of this outperformance last year in November, when the US market looked like it's going to top out. It was petering out, fag end, losing momentum, and some money probably shifted. So you saw the DAX outperform the US, for next couple of months, and we also saw that across Asia and a lot of the emerging markets. So if you look at even the EM ratio, I discussed both in Weekend with India Charts last time, but let me just now I'm sharing. Okay, so let me just share that chart. So this is the EM SPX ratio. Okay, what you see here is an inverted head and shoulders pattern on the weekly chart. I think anybody who understands the HNS, a lot of people do now. A lot of people write about it online. This is the most perfect HNS I could see, and we are on the verge of. We slightly broke out, pulling back. We're on the verge of this point. This is where we are, trying to break out. The RMI on the weekly is already turned bullish in anticipation. But yeah, we need to go past this line, move higher, and then it's clearly an inverted breakout. Okay. So what does it mean? It means that this long period of underperformance, see how long that is, of emerging markets relative to the US starting 2008, last crisis, and prior to that they were outperforming. That's the last dollar bear market. Okay, but the dollar bear market I thought started with COVID, but then the dollar made a new high in 2022, somewhere here. After that, the ratio is still falling, which means even after the resumption of the bull run, we didn't see a reversal in the underlying trend for emerging markets relative to US. But now, when I look at various Asian markets, they are vertically going up. So I think they are playing big catch up with US. It's very similar to what happens between gold and silver. That late stages silver catches up, and similarly we are seeing other markets catch up and start outperforming the US. I think so. This may be an early sign that just like I'm saying for Europe, even emerging markets, other markets, non-US markets, basically start doing better than the US. And I think we are in the infancy of this trend. As always, I'm trying to call something very, very early, but yeah, it should be happening. I think it started to. Second round seems to have started to happen just now.
Yeah. So after the discussions and all with the USA. So that's all for today. And let's move to the questions asked by our viewers. Starting with Pradeep Tiwari. He has the first question. In RMI indicator, can you bring intraday time frame?
Yeah, on Strike, it is going to be available both on the desktop and mobile in the next version upgrade. So it's already designed, but yeah, it will take a while for us to release that. But if you really want to use it, get in touch with our team for TradingView access. They can offer you a subscription to RMI on TradingView if you want to use it on intraday charts over there.
Moving to the second question is from Deepak Kakad. Please share views on metal sector.
So in a falling dollar environment, that's the next best sector that we should be looking at. But we are in an unusual phase where gold and silver are the only ones doing well. Oil is still down. Metals have started to pick up very, very slowly. If you look at copper prices, aluminum prices just broke out a few days ago. Zinc is slowly coming on behind, and nickel is not moving at all. So it's a very slow process that is happening. But I think Indian metal sector is doing much better because of the added combination of one, internal demand, infrastructure, etc., and second, currency weakness. So both are adding. So our metal sector is anyway doing better than the global metal stocks, and I believe they'll continue to do so. We're a long way from ending the metal bull market. So yeah, that's my view.
So moving to next question is also from Deepak. Are we already in a commodity super cycle?
I would like to think so, but we are in wave two. We haven't entered wave three yet, mostly being pulled down by oil. So while we are seeing it in some parts of the market, when we see it in, for example, coffee prices, but we don't see it in wheat prices, we don't see it in sugar yet. We saw the first wave in sugar in 2020, 22, but after that sugar prices have gone down and the third wave has not yet started. So I think a lot has to do with oil somehow. So it's but yeah, broadly yes, but the third wave, the next leg of the cycle, is taking time, but it's happening in individual commodities, just not happening across the board.
Moving to the next question is from Shubham Pandya. Sharp uptick in M2 money supply, surplus cash, cross assess asset prices, inflation as a store of value. He wants your views.
Yeah, I can only agree. It is happening. US has seen expansion, and yeah, there's a pro-inflation view even for the US, but it's not right. It's not like right away, you know. And somewhere, what is happening is US is beginning to accept that inflation is going to remain at this higher level. It's not going to go down because growth is strong, and therefore they need to cut rates anyway. Okay, so this is a very different outlook they're taking, which is partly why gold is out of control. You have inflation at 2.5%, and you start cutting rates. Of course, rates are still higher than that, but you're cutting interest rates and you're not targeting now anymore that it has to go below 2. Now it's like, fine, it's down enough, let's cut rates. And gold says, wow, let's go then, let's run.
Moving to the next question is from Sandy. Can Indian markets catch up with global markets as most of negative news has been factored in FII also are coming back with buying figures?
So I mentioned it in the beginning, but let me just say so much. Slowly at first, and then as the news becomes obvious to all, it would have caught up by then.
Moving to next one is again from Shubham. K-shaped economy kind of moves to be seen where government support sectors like AI and AI infra leading the way. Second part are from Hedge Eye, your view, sir.
So most of India's spending initially went to capital goods, right? If you just see the last several years, and now they've tried to slow that down a bit, but that support will continue. Eventually, they are hoping that the private sector capex cycles kick in, but the sectors that the government is supporting is definitely going to be important. So whether it's power, whether it's in the area of healthcare, uh, all of those, yeah.
Uh, so moving to next one is from Raghav Tandon. So what if the reduction of tax does not bring FII investment due to high valuations?
Valuations are not an argument. Growth is. High growth results in high valuations. Low growth results in low valuations. So if you have high valuations and you have growth, money will find it, whether it's domestic or FII. The only difference is your currency. Now, because you have such strong domestic money flows, the stock market is not going to stop because FII money didn't come. That can only save your currency. But if the currency weakens along with growth, the stock market will go up even more, because the stock market is a hedge against inflation as well. Don't forget that. So this FII side is not like the most important argument on earth. FII money doesn't come, growth will still drive up high valuation stocks. FII money comes, many other things might do well along with it. Maybe the currency will be strong, so it will make you more comfortable. And on the macro front, you'll not be worried about that. You might not be worried about the imports on gold impact. That's where the FIA will help.
Uh, Moving to next question, and it's from Twitter, asked by KD Patel, how to use option calculate and strike.
Oh, that's a complex question. Let's keep that for how to use
Uh,
option.
I think so that in the webinars, in the recent webinars, Jai has.
Yeah, I mean, ideally, you just go through that webinar, and if you have a specific question related to that, we will happily answer it. Even if you ask it there, or get in touch with us, we can answer specific things that you didn't understand from the webinar. If we can just link you to the webinar, but you can go to YouTube. So YouTube, we have a strike channel. All you do is type strike_IC on YouTube. Okay, and search it out there.
Um, for the next question, so, and this is the last question. Hi, sir. Now heading to new time high. Can you s- can you suggestion me? Sorry, it's a stock specific question. So I'm just
Yeah, like, see, there are videos, so you can just search it out. There may be others. Uh, you're saying Jay did one. Possibly it doesn't say calculator
yes.
in the, but yeah, if you just look at any of the options videos. So yeah, tell me.
So this is the last question for today's session. It's again from Shubham. Overall, BBG
I was
consists
sharing my
shows
screen.
India's earning growth. Sorry, sir.
No. I missed sharing my screen, so I'm just going back. So this is a strike IC channel. Like, there's something on open interest signals. Then there's yours one on options calculator, valuation tool for option trades. Uh, and possibly what you're talking about is no, this is on promoter move. So you can actually go through some of Jay's videos. You're seeing Jay did a webinar, so it should be
Or
here.
Mohit Agarwal, sir. I think so. Yeah.
So this
The
is on
second one.
Y Insights. This is 2 weeks ago, right? This one.
Yes.
So yeah, so that's what I suggest. Okay, coming to your question.
So overall, BBG
This
consists.
shows India earnings to move to 13%,
Yes.
which will solve in the valuation problem. PG becomes ratio becomes attractive. Yeah, I mean, that's fine. That's PG is in its own place right now. Market's not following PG; it's following things like market cap to sales and EV by sales, and so revenues are also being given a lot more weightage than just PEG ratios. So, in fact, India has been growing. Last year, it was growing in 23, but our P ratios are not going up. So anyway, the PEG ratios were coming down. Now, then growth dropped, so now it will look like it's high. So that logic will keep changing. But the market is anticipating. If it's not falling, also it's anticipating that things will pick up again.
So That's all
That's
for
it.
today's question. Yeah, that's it for today's question and answer session. So thank you everyone for joining. Thank you, sir, for your time and patience for all these long questions. We will be meeting again on Monday, same time. So stay safe, trade safe, and also use strike. So signing off. Thank you. Thank you everyone for joining. Thank you, sir.
Thank you.